Okay, very good morning. Wednesday, the 19th of July. Let's take a quick recap of a summary of yesterday, a quick look at the news, and then what we're looking out for throughout the session today. And I guess one of the interesting things here, obviously we leave the market, generally speaking, after European cash close, so normally around 5, half 5 or so. We tend to log off, but then looking at the markets when you come in, it's always surprising to see the recovery in the US equity market. Now yesterday obviously we came under some considerable downside pressure across all three major indices. The Nasdaq maybe faring a little bit better, supported on the back of specifically kind of sentiment related to Netflix earnings, which were extremely strong. They were up kind of double-digit percentage gains on the back of subscriber growth. But otherwise, the overall theme was that of some uncertainty about the more market-sensitive fiscal policies that Trump will be able to implement in future, given the failure once again to repeal the latest kind of version of the healthcare bill or repeal Obamacare. So earlier on in the morning, we had pretty early when the US came in, just given the fact that that news broke overnight, so the US really got a chance to react to it for the first time when they stepped into the market. And technically we broke, you can see in the S&P, the fairly tight range that we had traded on Monday to the downside. The Dow was probably even more aggressive in that move because we broke some technical levels here that we were looking at yesterday, which was the low on Friday and consequently the low on Thursday gave way, and you can see that really quick move to the downside. Now, I think both Sam and I were talking at that point in time because when you started to look at the size of the move from where we kind of opened down to that low, I mean, you're looking percentage-wise at about 0.75% or so, fairly decent size move. And what Sam and I were thinking was, well, there's nothing new that's actually occurred, and granted, yes, you know, a bit of profit taking from the more elevated move that we had after the weak data at the end of last week, which kind of prompted that view that a debt hike kind of factored off the table, supportive then of equities in a lower interest rate environment. That taken back, but it started to look a little bit overextended, and when you saw the break on these technical levels, what it looked like was potentially algos jumping on some of that downside momentum. It moved awfully quick. You could see the orders in the market getting hit and the price running lower. We were both waiting for around this 21,401 level. The previous kind of high is back on the 10th. And around the upper bound of that range for those 3-day period in the middle of July as a point to then just get in long to try and play the market back on the inevitable bounce that we tend to see in US equities. And we didn't quite get filled, but the move definitely occurred, and we recovered all the way back up in the US equities. The S&P actually in the cash finishing around record levels on the upside, if anything. You know, full retracement in the S&P. And this was kind of what I was talking about in the strategy yesterday. Although, yes, I see this as a Trump implementation risk being heightened by the likes of the healthcare bill being voted out by those Republican senators. Ultimately, this just means that the Fed can't remain as hawkish, and then this is actually supportive of equities. It's almost as if bad becomes so bad, it becomes good, if that makes sense. Because it just ultimately forces the Fed to have to be extremely cautious and gradual, and that tends to be, from an equity perspective, supportive, and hence we've seen this constant record high territory for such a long period of time. So it was just quite interesting to see that play out yesterday. Whether that will remain to be the case, yet to be seen. But moving over into the Asian session, well, first off, we had that slight divergence. The S&P pretty much flat, minor positive. The Dow was down 0.25%. The Nasdaq was up 0.7. So the Nasdaq, in fact, then outperforming, as I mentioned, with Netflix. The S&P maybe underperforming a little bit. We had a couple of bigger bank earnings yesterday. The headline readings were kind of Goldman Sachs and Bank of America. Both banks beat on their EPS and revenues, but it was really the kind of devil in the details, and it was the the performance of some of the core businesses. There's something you might see referred to called a FICC, which is Fixed Income, Currencies and Commodities Division. So that's kind of their trading divisions. And they were a little bit soft. And so the banks weren't particularly fantastic, albeit not a disaster by any means. One quite interesting statistic I saw Deutsche Bank pick up on this morning is that the S&P 500 has now gone 267 days without a 5% correction. That's the longest such streak since 1996. So we've not had, a decent consecutive pullback in these equity markets for a long time. And we're in an unprecedented kind of period now. And so yesterday, obviously, you saw it pick up and capitulate pretty quick. I would say just to be mindful of that going forward, because what generally starts to happen as you go into kind of late July and certainly into the month of August is that volumes start to tail off considerably as a lot of market participants are generally out of the marketplace. So what that can add to is quite range-bound markets, but if there starts to be a bit of a pickup in order flow, the market can move quite rapidly, exacerbated by the generally thinner liquidity. Okay, one of the other key things that moved yesterday obviously was sterling, and we had that UK inflation number. So just to refresh your memory, it came in at year-on-year 2.6%, considerably weaker than what expectations were of 2.9%. As I said at the time, very rarely do you ever see such a large miss against market consensus for an inflation reading. 2.6% then flies in the face of what the hawks were banking on, which was that there's a strong risk that inflation is going to run away on the upside well in excess of 3%, which requires an immediate rate hike to counter that trend. Remember, you had a 5-3 vote split in the June Bank of England MPC meeting. Well, it's going to be very difficult, I feel, for the likes of Christine Forbes has now left the Bank of England. So there's only, in effect, two hawks remaining, that being Michael Saunders and Ian McCafferty. It'll be very interesting the next time they speak, whether or not they can remain committed to their push for a rate hike. One would think that probably not, given the fact that the UK economy is expected to slow down. That has been evident in various economic indicators, and then that should then start to feed through into lesser demand and therefore lower inflation in the long run. Granted, if now we've seen inflation peak from that big decline that we had from last summer. And so one thing, I guess, with those hawkish members, I guess they won't want to lose too much credibility. So I don't think you'll get an outright reversal, but certainly monitoring their commentary could be key. An interesting thing is that Mark Carney spoke last night, and Mark Carney was supposed to be unveiling the new Jane Austen £10 note, but just given the fact that obviously this goes against this data point, the hawkish direction the Bank of England's been pushing in of late, certainly even Mark Carney himself has kind of changed view considerably. He actually spoke on policy at that event. So again, this is a good practice to get into in regards to if there's been a decent move or a large unexpected move in the market on that day, if there is a central bank speaker, irrespective of whether they're speaking off topic, what you might often see is they feel compelled to kind of guide the market with some commentary so that the market doesn't take this to kind of balance market expectations. Obviously what happened yesterday puts the market in, there's no way the Bank of England can remain hawkish under these circumstances. So what does Mark Carney say yesterday? Well, no surprise, he says, data does not change the outlook that price gains will remain above target for a period of time. So he comes out with a more hawkish kind of phrase to just make sure that this pound doesn't start collapsing to the downside, because he knows full well if we start getting back down to the lower bound of the post-Brexit 120 type area, although granted that's a long way off from current price, that's going to start to almost refuel this inflation issue. And so I'm sure he feels much more comfortable with it being around where it is at the moment, knowing that the dynamic for the economic performance and the uncertainty politically with Brexit negotiations, that there's already enough components out there to weaken this currency fundamentally in the next kind of 6 to 12 months. Just having a look at where cable is this morning, you had that low from late, I guess would have been Monday night. We obviously shot lower on the back of the data, immediately fell down to S1, came back to that level before then pushing down eventually in the early part of the afternoon to S2 before then recovering. We found a little bit of resistance around that similar price point, 130.72. I guess downside near-term levels, key levels, keep an eye on. You got 130.48, which was the Asia Pac low. Then yesterday's low coming in down at around 130.31, followed by S1 at 130.18. On the upside, some decent level at R1. If we were to get above pivot, then that 131.40 type area, that was the high print from Friday session, and also the kind of around the 10 pip band, encapsulating the highs that were seen for the week as well, just pre the actual release of that CPI is when we peaked. So a couple of levels there maybe just to consider. And just while we're on the the issue of currencies, just having a look at the euro currency, just talking to a couple of the live traders this morning about anything interesting that they're looking at. And you've got a bit of a cluster of price activity quite close to where we are at the moment from yesterday's session before we saw the eventual push higher on the back of the weakening dollar on the healthcare failure in the US. I feel that's a little bit aggressive, maybe trying to get in at those levels. What looks a lot more compelling is probably that S1 level, 115.28. The reason why you've kind of got not only the S1 level, but you've got the kind of 2 times it's acted as a decent level as resistance on previous occasions, back on the 12th and also on the 17th. So maybe if you were of the opinion that we could see a bit of a further extension of the dollar weakness, or in fact euro strength, given some of the hawkish hints we might hear from Draghi tomorrow, then that could be an interesting entry point for the long. In terms of the dollar index though, this morning, obviously yesterday it was down well in excess of 0.5%. This morning it's up about 0.15%. So it's a little bit of a recovery, albeit it's still only retraced probably about, I'd say, 40% of the fall that it saw on the back of the dip on the healthcare failure. Okay, a few other headlines just to get you up to speed on from a news perspective for the morning. Donald Trump, can't really go a briefing without mentioning Mr. Trump, and what has come to light in the press this morning is obviously we had the G20 meeting only about a week ago, and Donald Trump is said to have held a second and private meeting just between him and Vladimir Putin, which obviously raises a lot of eyebrows when there's obviously Donald Trump Jr. about 2 weeks ago was found incriminating evidence that he was having some meetings with Russian lawyers who had inside dirt on Hillary Clinton in the run-up to election. Donald Trump himself cozying up to Putin when he first became US president. And so, you know, it raises eyebrows when there's a G20 meeting of all the major powers globally, and then he's off on the sidelines having a chat in the corner with Mr. Putin. Obviously, Trump has responded on Twitter, you know, the common place for him to communicate, and in capital letters, no less, fake news is the headline on Trump's Twitter account this morning. So I wouldn't say this is anything too market moving, but certainly I wouldn't say this really helps his case at this present point. Certainly not when the G20, if you remember at the time, it almost felt like it was the G19 plus a tag-along one, which was Trump, with his very protectionist kind of views on many different policies, kind of looking at him quite separate to the rest of the group. This probably only further drives that divide, I would say. Looking elsewhere, the other big things obviously that are occurring this week are the ECB meeting. That's not happening today but tomorrow, but certainly the preparation is already underway for that. And for Mario Draghi, this is going to be quite a tricky meeting, because as what the FT is stating here, there's a delicate governing council seeking to balance between beginning to phase out reducing QE and acknowledging weak inflation. So you've had this pickup in European economic performance, which would warrant now stepping down the QE program, i.e. starting to phase out such an accommodative monetary policy stance. The only problem is, as what we've seen in the UK now yesterday, as what we saw in the US on Friday last week, as what we've seen in New Zealand with the RBNZ, inflation is not going in the right direction. If anything, inflation is falling away from target. And so this is the real balance that Draghi's got to find tomorrow. And what this ultimately means, when it's a very difficult line to follow in order to convey your intentions to the market correctly, this then usually results in volatility, because it's very hard to strike that right balance. And so tomorrow's ECB meeting is going to be really interesting from a trading point of view, and I'm pretty sure it's going to throw up some good opportunities. And obviously one of the big things that we saw only around what would have been, I guess, 3 weeks ago, that Centrum meeting in Portugal, where it had all the heads of the major central banks. This is when, well, let me just show the comment first of all. Mr. Draghi claimed in late June that reflationary forces had replaced deflationary ones. So this is him getting a lot more upbeat that actually, don't worry about falling inflation. What is happening is the Eurozone's economic recovery is on track, and we're going to get reflationary forces taking place. What this prompted then was a really sharp move higher in German, so the benchmark European yields, shooting on the upside. So the Bund came under significant selling pressure, that inverse relationship. And you can see here psychologically, for the first time in a long time, we broke 0.5% on the upside in German 10-year yields. This saw, as you can see, a further extension of that move, put Bunds under more selling pressure. So you can see how just simple wordplay has really caused the market to kind of reposition itself. So it's going to be very telling. On that note, as I said yesterday, the thing you guys should look out for is, given this almost tricky meeting that Draghi has, be mindful of ECB sources. All the more reason that the ECB probably wants to drip feed in via the back door, if you like, via sources, giving the market some hints as to what potentially could come via the communication in the press conference, so that they can manage the market volatility and try to deliver a message with a minimal amount of fuss, or kind of most price stability that they can ensure to the market. And so last night at about 6 p.m. you had a Bloomberg source. It was basically saying the ECB is studying stimulus options for possible full decision. So it's not particularly new information. Options for winding down QE said to be evaluated by ECB staff, but there is little chance of policy change until after the summer. So I wouldn't say this is particularly new. Hints that might come prepping up for then September, when we'll start to see some more concrete details emerge. But certainly I'd keep an eye out. There could be more sources coming from the likes of, obviously, competitive or competitor news agencies such as Reuters, for example, because this came out on Bloomberg last night. Sticking with central banks, I saw a good graphic because we have the Bank of Japan decision as well this week, and very rarely do you see a Bank of Japan hawk-dove scale. And so I thought I'd share it with you just so you can get an idea of where the balance of power lies within the BOJ policy board. And as you can see, there is two quite clear outliers from the pack, Sato and Kiyuchi. And the interesting thing here is that both these two in the bottom right hand corner are, this is their this week their last meeting. After this week, these two are out of the picture. So what does that leave you with? Well, it leaves you with a very tight cluster around, obviously, Kuroda, who is the governor and is, as you've heard, with all this hawkish central bank speak, remaining resolute about how dovish she is. If anything, they've been revising down their inflation forecast to validate that view. Now, there's two replacements that have been mooted as coming in. Banker Hitoshi Suzuki from Tokyo Mitsubishi UFJ and an economist Goshai Katayuka of UFJ Research and Consulting. So both of these two, though, the most interesting thing is they're both said to be closely aligned to the existing group of having a more dovish view. So it just cements then the long-term perspective and thinking that the Bank of Japan are very unlikely to make any changes, unlike some of the other central banks. Just before I continue on, I'm just keeping a half an eye as I'm talking on the pound, just coming down to that post-inflation low here that we had yesterday, 130.31, so within the 10 pip range of that at the moment. So the dollar's still looking to make a bit of recovery. Obviously Euro's found a bit of resistance and been just edging slowly lower from pivot earlier this morning. Okay, moving on, let's have a look at oil prices, and in particular, let me just highlight it for you, is this candlestick, obviously a negative open on the 30-minute to the close with some high degree of volatility as denoted by the wicks on either side of the body. And this, of course, coming amid the API crude oil inventory report. So just recapping what the numbers were, the crude headliner build of 1.628 million. Expectations were for a drawdown of 3.5 million, so a surprise build. Cushing build 608,000. Gasoline, though, was a drawdown of 5.448 million. Expectations were for a draw of 1.3. Distillates a draw of just shy of 3 million. So you had an incredibly bearish headline, but a bullish gasoline figure. So you've had a little bit of a, on initial response, negative, but I'd say contained. And then as we've come into the European entrance, we're pretty much exactly back to the price point where we were before that data came out. So maybe the two numbers negating each other to some respect. So mixed APIs, that would mean that we might get a fairly cloudy picture emerge from the DOEs we'll get this afternoon, which obviously makes it much more difficult to navigate and trade effectively in the short term. US output obviously is a really big deal, as per usual. As you remember from the charts that I shared from last week, US output is tracking at year-to-date highs. And so that definitely needs monitoring. I think the last 2 consecutive weeks we've been up 1% and then followed by 0.68%. So some very strong gains in US output. And then if I just bring up the chart in terms of what does that look like, if I just transition, because I remember tweeting it at the time here, US output is currently tracking at 9.397 million. You can see, despite that brief dip we had about a month ago, we are right back on trend of pretty resurgent output coming out of North America at the moment in the States. Okay, looking at the calendar for the session, you have a very quiet morning. Not a great deal going on. And the afternoon is where the bulk of the scheduled events are centered. You've got housing data starts and building permits for the month of June, and then you get the oil inventories at 3:30. So overall, I'd say it's a fairly quiet calendar. There are a couple of corporate earnings to be aware of. From the banking side, well, let me just quickly show you this page yesterday. I did cover this in the EU wrap yesterday, but this is something, if you haven't already done so, it is very good practice or habit to get into. And this is going on the Bloomberg earnings calendar. And typically what I would do is at the end of the day I would review this to prep myself up for the day after. Actually, something's just caught my eye here. Just having a look at gold here, just had a little flash move to the downside. Can't see it based on any actual specific commentary, but obviously we've just broken beneath that early European morning low test. Quite often see this when you have reports then start to circulate about a large trade order that's gone through at a fairly quiet, illiquid time of day. And maybe that's what's led to that little blip low. It's already recovered though some of that move. Nothing fundamental that I can see though. Just going back to, sorry, that was the gold move I was just looking at here on a minute chart. There was just what we just saw there, we've just been talking about. Just going back to the earnings calendar, this is certainly something that I would get in a good habit in doing. And this is clicking on the calendar, looking ahead to the next day. So let's look at today's calendar. And basically what I do is I skim through and look for any either large cap names or bellwethers for their kind of sector. And so here, if I was scrolling down, if I was looking at material names and what used to be the unofficial commencement of earnings season with Alcoa, could be quite interesting in terms of aluminium demand. You've then got Amex, which is obviously a large capped financial related firm. Scrolling down, let's have a look. Qualcomm, I would imagine Qualcomm will most likely be aftermarket. So you can see, I think Morgan Stanley is here as well from the banking names, but bearing in mind we've already heard from several of those type of institutions, I'd say it was probably largely priced in now from a financials perspective. So it's not about trying to look at every single earnings when you're looking at the overall index future. It's just about knowing what the risk is. Okay, just being alerted that some of these other markets are moving around it a bit, and I'm just looking at a comment from ECB's Villeroy, it's come out the last few minutes. We still need accommodative monetary policy, but are adapting its intensity depending on economic situation and inflation. So, comments out of an ECB speaker. Let's just have a quick look at the euro. It's on session lows as I speak. Nothing massive outright move. The comment came a few minutes ago, so we've trended a little lower. Again, that was ECB's Villeroy stating that we still need accommodative monetary policy. So certainly that's a little bit against, I guess, the kind of broader consensus of them having a more hawkish line of late. But we have heard similar type comments out of Visco, Remsevich as well. So it's not particularly unusual. Let's just have a quick look at the Bund. Yeah, not seeing a little bit of an uptick the last few minutes, so maybe that comment getting a bit of a look in. Yeah, so minor moves, weakening in the euro and a little bit of a bid tone in the Bund. Okay, that's pretty much it though for your morning briefing. I'm going to leave it at that. So any questions, please do pop them in the chat room on Trading Live. Otherwise, have a good day